Well, hello everyone. For those listening live, thank you very much for joining us this afternoon, and a warm welcome to you. And to those watching again online, thank you very much for listening. So, HR Solutions are very pleased to be joined today by Lumin Insurance, and they are here to give you a different webinar today about protecting your business's prized assets, its people. So we're just going to begin by introducing ourselves. So from Lumin Insurance, we're very pleased to have the Managing Director here today. His name is Toby Davidson. He'll be leading the webinar today. Some of you may well know me, but I'm Karen. I'm the HR Knowledge Manager at HR Solutions. And I'm also joined by my colleague Atim Arden. So she is our Digital Marketing Executive at HR Solutions. So for those who are listening live, a team shall be fielding any technical problems, okay, in case they crop up. Hopefully, of course, there will not be any. But if you should have any problems, if you could just let us know, because it might be something that's affecting everybody, and it's something we can resolve our end. So if you could just use your control panel, just drop her a message and let her know, that'd be great. Equally, as we go, if you have got any questions, you can use your control panel as well to send those over to her. We'll be collating them as we go, and if we can, we'll try and put some of them to Toby as well. But if we don't manage to answer your question, then we'll look to come back to you after the webinar directly, which is great. So thank you, Toby, for doing that. So that is us introduced. So welcome, Toby. Thank you very much for coming along today. I'm now going to pass over to him to introduce us to this topic. So here we go. Thank you.
Thank you very much, Karen and the team. I've had a very warm welcome here already. Hello to everybody listening, whether that be online. As Karen's just briefly alluded to, my name's Toby Davidson. I'm the Managing Director of Lumin Insurance. And we're a specialist provider of insurance to corporates and SMEs, which is why I've come here today, because it's particularly pertinent, knowing that a lot of the clients of HR Solutions are, as I just mentioned, corporates or SMEs. The particular subject today that I wanted to kind of talk about was actually protecting the businesses that all of us are involved in, you know, whether it be my business, whether it be HR Solutions, whether it be any other business out there. And within most of the businesses out there in this country and in the world, people are absolutely integral to the growth and future success. And so therefore, when I talk to businesses, it's getting them to understand the repercussions of the loss of a key person or individuals within a business that can have an impact upon it. And we all know, and we read it in the news, whether it be a huge business like Thomas Cook or whether it be small businesses falling by the wayside, that in a fast-moving global economy, the increasing pressure on business owners and management teams is never been greater. You know, and everybody is wanting positive returns. You know, they're wanting to be competitive and they're wanting to kind of talk about their business now almost in a global capacity than they've ever had before. And so therefore, ensuring or protecting your key people and shareholders, you know, as you can see on the slide, has never been so profound before. And what do we mean by that? You know, what I'm talking about is the underlying and, you know, unknown and uninsured health risks within, you know, management teams and key individuals that can have a significant impact on the business ability to grow, remain profitable, and actually survive. You know, and that's so important. You know, without the survival of a business, people's jobs are at risk, and so we need to make sure when we're thinking about how our business is stable from the bottom up, that we're making sure that people are at the basis of that coverage. I think what's also brought a lot of this to the fore, you know, has been auto enrollment in recent years, where people are actually starting to focus, because of the legislation that was brought in, about their people, and therefore how they put the necessary benefits in place to not only provide for them and their families in the long term, but also to provide the businesses with a stable source of income from those people. And it's all too easy to talk about group schemes, whether they be pension schemes, whether they be group life, group death and service, sorry, group critical illness, group income replacement, group private medical insurance. And they're quite well-known phrases out there, but not enough people are actually talking about the bits that keep the business going, which is ensuring the drivers of the business to make sure that it remains profitable, can grow, and can survive. And without all of those interlinked areas, there really isn't a business for people to work in. So the first part that I'd like to talk about is key person cover. And I know it might seem an obvious subject to talk about key person cover. However, not everybody knows what people mean by what is a key person. And key person insurance, as a headline, is there to safeguard a business against the financial effects of a death, diagnosis of a critical illness, terminal illness, or the total permanent disability. And it provides the business, in the event of one of those aforementioned areas occurring, with immediate cash flow. And when I mean immediate cash flow, normally insurers will pay out within a successful claim of 7 days, 5 to 7 working days. And it provides that business with instant continuity as far as cash flow is concerned. That cash flow can be utilized in many different ways. And as you can read up there, is it to bring in a new individual? Is it to cover short-term loss of profits, reduce leverage and risk? Leverage and risk might be borrowing that the business might have. There might be a shortfall in cash flow within the business whilst invoices are being paid and sorted, and suddenly the business is up against it because they're unable to meet their bills. And so therefore, this is part of what the insurance can be utilized for. Now, many others you might be thinking, well, who is a key person? What are the impacts that they can have upon it? As we were discussing before we came online, I think if everybody was to sit back and think about their business now, when we were thinking about key people, who would have an impact upon the business automatically? And I'm not just talking financial, but it could be logistically, it could be administratively, but had an impact upon the business almost instantaneously. And that is kind of who it might be as a key person. It might be a skill that they have, it might be knowledge that they have, it might be a role they're in. And how do you replace somebody who's in a really specific role? Or how do you replace the person that has a huge Rolodex of contacts that keep a flow of business coming to the business? Or is it one of the key directors whose vision it is that they've set up the business, and how do the other directors keep it going knowing that that person's not there? And as you can see up on the screen, that could be any one of the people we just mentioned: managing directors, salespeople, analysts, software developers, finance directors, head of HR, whoever it might be. And this last particular extract is taken from Legal and General, who are one of the largest insurers out there, and they've got a State of the Nation SME report which talks exactly about this. And I know that this will be going out later for people to kind of have a look at it in more detail, because it contains a huge amount of facts and figures about the research they've done. But if you read that last bullet point, it highlights how crucial individuals are and key individuals are to a business, and within businesses kind of pretty early embryonic stages of growth, and actually the report would say that continues really up until kind of the 5th year and beyond. So the first year is, unsurprisingly, is absolutely integral. However, that often remains throughout. As teams are strengthened, as businesses grow, they still have at the core of them some individuals who are driving it forward, and their loss would have a significant impact. So let's key person insurance, and here are just some of the questions that I was talking about. Has the business considered the risks, the business of losing a key person or business owner? Possibly not. Nobody wants to admit that they're fallible, and that in the event of something happening to them, it could have a detrimental impact upon the business. But these are, when a business's survival and future depends upon it, these are when these difficult conversations need to be had to say, actually, do you know what, you are key to this, and actually your loss would have an impact upon us and everybody else that's employed within the business. It's not just looking in, it's looking out as well. How would creditors react to such a loss? The scrutiny that's applied by creditors to everything now is greater than ever. We're all culpable for and on the hook for advice we give, or monies that are owed, and the logistical chains that we have in place. What that creditor think, right, have you just heard that individual's being lost to that business? Well, what does that mean? Are they going to pay our bill? Are we going to put more business? Are they going to cope if we start to push more business their way? And then similarly, from a supplier perspective and a customer perspective, it doesn't take much for that information to get out to suppliers and customers. And once again, people do start to question, well, is the business in a stable position? Has it recovered? Is it going to continue to provide the services that we bought off them or want to buy off them? And the last bit, how could the loss of this nature affect staff? And I know that this is a very emotive piece, because in SMEs, everybody gets to know each other pretty well these days, and we're all interconnected in a way. And how would the morale of staff be impacted? Probably quite severely. And so therefore, are people going to be distracted? Are they going to be focusing on their job? Are they going to be able to keep driving it home in the way they were? Are they going to feel as comfortable? Are they going to be worried that actually, well, that person who's left, are they going to be able to continue to pay my salary? And I don't think enough is thought about. And one point that we were discussing before I came online, it's all too easy when people walk into a room within a company, and the first thing they'll look at insuring is the TVs or the computers or any fixtures and fittings. And actually, most businesses do that, whether they put in office contents insurance or they put in place warranties for the equipment they've got. One of the first things they do, actually, but what they should be doing when they're looking in that office space, is looking at the people. And I think we're all guilty of doing that. If it's, we all do it personally, we all look at kind of home contents insurance, car insurance, pet insurance, without actually looking at the people inside the building or inside the families. And so that's kind of what we're trying to flesh out, is saying, have these conversations, have these thoughts, because it might be a morbid conversation, might be one that nobody really wants to broach. However, think of the consequences if it isn't. And for the sake of a 10, 15-minute, half-hour conversation to say we should put these safeguards in place, the upshot of that disaster is minimized as best as possible.
I think this is a really interesting, topic, especially if, anyone is listening who's very familiar with absence management, for people who are on long-term sickness. We quite often do webinars about how to handle that and how to manage that. And, sometimes we also have to think about the knock-on effects that it has on the rest of the staff who are left over. Not only are they concerned about, the person who is very seriously ill, but they are also then effectively probably going to have to pick up the slack, to some extent. And if this is a very critical person to the organisation, it might then bring additional fears about, could this even bring about, a redundancy situation if we can't meet demand anymore, potentially. And if perhaps there is then this insurance in place where it means actually we are not going to have to be concerned about the loss of inflow of finance from that person not being around anymore, then it's going to alleviate that pressure, isn't it, on everybody in the team and on the business as well.
That's exactly right, because it isn't just, it's not just, losing something in the worst case scenario, which is to unexpected death or accident. It can be a long-term illness. It can be a critical illness. And the point of key person cover, as I mentioned, the previous side, is it's not just life cover, it's critical illness, it's total permanent disability. The latter two, if somebody is critically ill, you know, these days, people are actually returning from suffering a critical illness at a greater number due to advancements in medical technology and service out there. So they could survive, but they could be off for some time recovering. And so that, you know, if they're still on the payroll, if they're still part of the business, they might be a shareholder, they're still drawing upon the business's resources. And it's how you can provide the business with a greater degree of slack from a financial perspective. You know, we're never going to heal, it's never going to heal the wounds, it's never going to heal kind of the loss, but if it can provide some type of kind of comfort blanket from a financial perspective, that's exactly the point of it. Shareholder protection. Now, this is unsurprisingly focused upon the shareholders, and I bring. This is an area that's rarely talked about. Key person cover. You make that association with the key person, and you think, okay, well, we're trying to cover that person. Shareholder protection is really only focused on the shareholders. And the reason that I talk about this is because nearly, as you can read up there, nearly half the businesses have no specific arrangement for their shares. The owners rarely have a provision put in place, not only for their own estates, but then also with the other directors and shareholders in the business. And as I mentioned earlier, the legal and general report that you'll be able to access, of course, will go into a little more detail. But just they're not doing it, the conversation is not being had, and the ramifications for it not being put in place are really quite severe for businesses, because shareholders are the controlling component to a business, and without them having a joined up framework, it puts the business at risk, not only from the other shareholders' perspective, but because the business then becomes involved because they're shareholders, because you then start to bring in the deceased or critically ill shareholders and state into the whole piece, and that's when it can become not only messy, but not necessarily kind of run in a manner that might fit the requirements of the business, because the shareholders need to make sure that they've lined up all of their concerns and mitigated them. And so similarly to key person cover, the point of it is it covers an individual if they were to die, being diagnosed with a critical illness or a total permanent disability. And it provides the funds for the surviving shareholders to purchase the shares off the deceased shareholders' estate. Because if they don't have the monies and the estate of the deceased shareholder calls upon that and says, well, I'm rightfully entitled to my spouses or siblings or whoever it might be, ownership in this business, I want it now. They have a legal obligation to call upon the other shareholders to demand that money. And if the business doesn't have sufficient cash flow or capital reserve to do this, they then find themselves in a very tricky position. Now, what do? Do they start to sell elements of the business? Do they go out to raise money to buy it out? It becomes really quite messy. And no different to kind of key person insurance, as we were talking about earlier. You've then got the fallout from the death or criticalness of that shareholder to deal with anyway. You then place on top of that a huge financial pressure when the estate is reeling from the impact as well, and it can create, you know, a nightmare scenario. And so the idea behind shareholder protection is that the surviving shareholders take out a policy that ensures each of them, and there are a couple of different ways of how to do it, but the one we'll talk about today is that they're effectively insure themselves for a proportional amount based on their shareholding on each of their lives, and therefore in the event of something happening to them, the insurance would then pay out to the surviving shareholders, and they would then purchase the deceased shareholders' estate. And that means that the other shareholders can then continue to run the business. They can allow this deceased shareholders' estate to exit the business. Some might want to stay in a smaller proportion, but want to crystallize some of the value that their, as I said, spouse or sibling, whoever else might have created. But the aim is it allows the business to continue to operate in a manner that it had done prior to this event occurring. And it just minimizes the risk to the business and the owners, and as I said, maintains the control by the surviving shareholders, gives them a fair value so that nothing is done underhanded. It's all legally written with cross-option agreements in line with the Articles of Association within the business. And so therefore nobody is trying to be shortchanged this because it's legally written in. Without this, as it says at the top, with nearly half a business not having this, you run into a legal minefield of opportunities for lawyers to get involved, accountants to get involved, and suddenly you've got all of their costs to factor in, which is taking the emphasis off the business. And that can really lead to kind of a dangerous scenario. On the next page, the key questions. I mean, I've answered that, but it gives you an idea of the two scenarios. They're very interlinked, but it's all to do with control. It's all to do with ensuring the business continue to operate from an ownership perspective, from a shareholder perspective. It makes everything really clean and cut and legally underpinned. And without that, it can have serious impacts upon the business.
From a HR perspective, that's screaming out to me redundancy situation, straight
absolutely
away.
Right. It throws up so many. The key person side is obviously, it's in a way is a bit more clear cut, because you're saying, okay, well, what's the impact on the business? That person's deceived, but that key person might not be a shareholder. Sometimes they're both. But when you've got a shareholder who might not be hands-on in the business, they might have been there at the beginning, but then as the business grew, became less involved, but still maintained a shareholding. So that something happens to that shareholder. From an arm's length, that has an impact upon the business. And as you said, there's suddenly legal ramifications. There's redundancy HR ramifications if the business almost starts to grind to a halt because there's infighting amongst shareholders. I mean, you'd hope it's normally amicable, but I think we all know the best things in life seem amicable in the outset until things start to go wrong. And then I think people start to kind of really cover their own backs. And the shareholder protection piece just ensures there's really good corporate governance in place with each business that prevents potential infighting and angst among shareholders whittling down to affecting employees, as you said, when redundancies can come in and people feel kind of slightly helpless on a completely different scale. But as I mentioned Thomas Cook earlier, look at the impact that has had on employees who had no idea what was happening right at the top of the business.
Yes,
right at the top.
Many of those probably listening are more likely to be in roles where they're quite operational focused and focusing on that, and so concerning themselves with ensuring that service, and production and sales are there, and that we're not going to be, risking redundancy situations from, a risk like that. But this is almost something that could sneak up on you from behind, as you say, from the top level, that you might not necessarily think about as ever being something that you have to worry about. But straight away, that could have such a profound impact on the stability of anybody and everybody's position in an organisation.
As I said, I just think for me it comes down to having really solid corporate governance put in place, of which any operational individual or person that's part of management or even advising management should be raising and saying that this is best practice.
Yes.
Whether it be from a legal perspective, whether it be from a HR perspective, whether it be financial perspective, we should be covering our backs, from top to bottom. And it's all too easy to not do that, and then find yourself in a scenario where it should have been raised, and then the worst case scenario happens.
Does the shareholder have to agree to this?
You'd hope. Well, yes, is the honest answer.
Okay.
And that's where, depending on the amount of shareholders involved, this is where, as a quorum, they have obligations as shareholders that they need to meet for the business anyway.
Yes.
whether that be at board meetings or shareholder meetings. And so therefore, it would be a topic that they need to make sure they collectively have a plan in place. Others might go, do you know what, we have sufficient cash flow in order to buy out the C shareholders' estate, so therefore we don't need it. However, in majority of scenarios, the insurance is the most cost-effective way of saying, rather than denting capital reserves of the business, rather than drawing upon potentially a loan from a lender to be able to buy it out, you're utilizing the insurance policy to do the exact same job.
Great.
And so it makes it much more palatable from a cost and a ease perspective. For, so as I talked about in the other two situations, when the worst case scenario happens, you want as many simplified processes as possible in place, so
absolutely.
that there's enough stress and strain going on the business. It just needs to be able to kind of operate as best as possible when that happens.
Yeah.
Business loan and directors loan insurance, similar to shareholder protection, that it does focus upon the management, maybe the regional directors, the directors, some of the shareholders, and we kind of talked about this before we came online. Where often this occurs is when a business has been set up from scratch by founders or original shareholders. They may have drawn upon a loan to set up the business, whether it be commercial loan, so from either a bank or a mortgage company, to be able to get the business up and running. So they want to take £100,000 of seed capital to say, right, we need to start to employ people, we need to get some premises, we need to get some marketing, we need to start to go out there and start to transact, we need to grow the business. And that loan, from a business perspective, will sit on their balance sheet, might not have been paid down because they might have a long-term repayment solution with that particular lender. And the business is moving along nicely, but if something happens to one of the directors who has partaken in that loan, and suddenly the business has started to be impacted by that, and the lender starts to call upon that loan to be repaid, or you've missed loan repayments, you can set up an insurance policy on the directors who have taken out that loan, or the business, to be able to say, fine, we can repay this loan in the event of something happening to one of the key people. And that's really important, just to kind of clear your decks of debt, because once again, I know I keep utilizing it as an example only because it's in the news, but Thomas Cook was undone by debt, and it was undone by a huge amount of debt, and it couldn't continue. Now, an individual didn't die in this situation, ultimately the brand died, but in an SME situation, if something does happen to one of the individuals who's taken out that loan or has been a guarantee for taking out that loan within the company, the same thing can occur when the lender starts to say, we're the first port of call, we expect that loan to be repaid. I see this quite a lot in other parts where I advise, which is for private equity transactions, where they will be utilizing banking debt to purchase a business, but the lender will say, fine, but this is contingent on the directors having some form of insurance so that there's at least collateral against it. And the director's loan, like the business loan, they're inextricably linked. The difference with director's loan is they might have put their own money in. So rather than it be a institutional lender that they need to pay off from a loan, it'll be actually the estate again. So it might be that the individual, when they set up the business, or individuals, plural, put in some of their own money, some of their own savings. They might have leveraged against their property to put money into the business. And once again, sitting on the balance sheet is a director's loan, which has been put in place to help the business grow. And then if something was to happen to them, that loan then becomes part of the deceased director's estate. And so therefore, the estate can then start to say, well, we loaned the business to get it up and running, money, or whoever it was with the relationship within the estate had loaned the money out of good faith, out of putting their potentially their family home against a mortgage to do it, and they're saying, well, where's our repayment of this loan? We need the money. We don't want to be involved in the business anymore, or we need the money. You know, the individual's not bringing the salary. You know, I've got a mortgage to pay. I've got a family to look after. Whatever the situation might be, and that situation was when you find the business finds itself having an estate calling on it to say, where is the money? You know, how are we able to get this money back? And it becomes contentious situations because you've got two different individuals or organisations. You've got an institutional lender potentially for a business loan, and then you've got the director's estate wanting their money back. You know, it's no different to any of us. Most of us do is have a mortgage. You know, if something happened, the mortgage company would want that mortgage paid off. You know, exactly the same principle. And a lot of SME businesses have business or directors loans with them because that's how they became an SME in the first instance. The directors made that bold call to say, I want to set up a business. And I need to find some capital to be able to do that. There you go. And I think that kind of reinforces what we're just talking about.
So really, anyone who's put in their own money or secured cash against an asset, they can afford to insure that. Really
absolutely right. You know, and you know, I go back to what I said earlier. You know, at the beginning, when all of these situations happened at the beginning, it was always done in good faith. Don't worry, I'll lend money to the company. You know, I believe in this company. I believe in the people in the company. I'm prepared to kind of leverage against my own property because this is the right thing. You know, they sit down with their husband or their wife and say, this is the right thing for the future of this business. We need to do it. We're taking on the risk because we're putting potentially our family home on the line. And in order to allow the business to grow, to then create the future for them and for the people within the business. But then if the worst case happens, then that good faith that initially started then turns into, well, actually, I need that repaid. Or actually, remember, we put that in good faith, but we're going to need to be this repaid. When is this going to be repaid? So it's very emotive because it's somebody's money, you know, being asked back for having been lent in the first instance. The last area kind of assuming kind of protecting people, and this bit actually you could open up a bit more into. We haven't in this particular scenario. You can talk about employee benefits. This is classified as business protecting one's business, but there's a fine line between a relevant life plan and employee benefits, like a death and service benefit. A relevant life plan or policy was created about 10 years ago by all of the major life insurers, because there's an increasing trend for individuals setting up businesses. You know, the growth, as we've seen throughout this country, of SMEs, and they wanted to have a lot of directors or owners or small businesses didn't qualify for group schemes. And there are group schemes that now do it, but it used to be 10 years ago you needed a minimum of 5 people to qualify for a group scheme. And then similarly, in order to get the economies of scale, you need to be kind of 10 to 20 plus. A lot of SMEs weren't that big, and identified the need for needing some form of company paid death and service or life cover. And so the idea behind the relevant life plan was to provide directors or a small number of employees with a company owned and paid for death and service benefit, but it would be for the benefit of their estates. And in order to give it more of a USP, they made it as tax efficient as it can be. And so when I mean tax efficient, the company pays for the premiums. The premiums qualify for being deductible against corporation tax. It is not classified as a benefit in kind for the life assured, and then currently it pays out tax-free into a trust, and then the trust then moves the money to the beneficiaries listed by the life assured. It has been utilised by higher earners because there's the lifetime pension allowance decreasing. It's now down to £1,055,000. Your registered death and service scheme can have a conflict with the lifetime pension allowance, i.e. if it is a registered death and service scheme, it would form part of your lifetime pension allowance. So if you had a £500,000 pension, and then maybe you had £600,000 or £700,000 worth of death and service benefit, the combination of two would put you over the £1,055,000, and then it'd be taxed at 55%. So you tend to find that directors and higher earners in business tend to separate out their life cover, their service benefit, because it's more tax efficient to do that. The other key bit is that, the other key bits to it, are the term can run to a maximum age of 75, and it's written trust, as I explained, and it's portable. So the individual could be underwritten, for this policy when they're 40. If they stay with the business for 20 years, and they'd set the term to age 70, if they stay with the business for 20 years, and then they wanted to move to another business that was prepared to accept it, the premiums would still be the same as they were when the individual took it out when they're 40, and they can port that cover to a new company, say when they're 60, maintaining all the benefits of the premium being set when they're younger, and also ensure that they don't have to go through any new medical underwriting, any collation of new medical data, any disclosure of potentially any health concerns that have occurred in that 20-year period. And so it remains a really efficient way of moving company-paid life cover to new organisations. And when I talk to company owners and directors, often they're saying, I'm paying for this life cover personally. We aren't of a size to necessarily have a group scheme, or we don't want a group scheme because it's not necessarily the best fit for us. Is there anything out there we can do? This is where a relevant life plan comes in. Rather than the individual paying for the policy out of their own net salary, the business can take on the payments instead. And so it's a, if there's such a thing, it's a sweetener. But it just means that there's a bit more control from the individuals insured than they would be if they were in a group scheme.
Mm-hmm. So this is something that could be more cost effective than a death in service benefit.
Not necessarily
for some individual. No,
but not on a wider company scheme. A group scheme would be better. Mm-hmm. For individuals, for some of the individuals within the organisation, mm-hmm. it wouldn't be. And when I say some of the individuals, it does fall very much to probably some of the directors and the high earners in the business, because their own personal positions might mean that it's better to be outside of the scheme. But if you're looking at this, and this is why I think there's a thin line, or fine line, as I said earlier, between this and employee benefits, it falls into that same camp. And so that's when you can start to talk to companies about, well, if you think about relevant life plan, this might be applicable for a couple of individuals, but at the same time, if you're less enamored by wanting to set this up on the individual side, you can put in place a group death and service scheme, group income replacement, group critical illness, and group private medical insurance. And so those kind of four areas of employee benefits sit very much interlinked with the relevant life plan.
So you could have this for certain individuals and not for others.
So depending on. I've found so far with the clients that I've got that that some of the directors and the managers will have a relevant life plan, and then the company employees or one employees would fall within a death and service scheme, or death and service scheme is the exact comparable really to the relevant life plan, purely because of the way the tax system is sorted out and set up, and so it's making each situation, whether it be those eligible for relevant life plan or those who are suited to a group scheme, giving them the exact same advice, but each product is kind of more beneficial to the separate segments. And that's why you have to have that conversation, so that it might be better all of you go into one scheme, but it might be better if we separate them out. And that's really when people like myself or others who are advising companies, once they get to know and understand the requirements of the business, you can actually give them the best possible advice in this area.
And the plan, I take it then, would pay out to the business?
No, it would pay out to the estate direct.
It would be, right, okay.
Yeah, so it's just a life insurance policy that's paid for by the company, but would go direct to the estate. And as I said, because it's paid into a discretionary or relevant life trust, the proceeds from that payment would be tax-free to the beneficiaries. So it might be a way of people wanting to move monies intergenerationally down to their children, or moving it to their other halves, or whoever it might be, whatever their will or scenario sets up.
I see. Thank you.
And the last area, why us? Why Lumin Insurance? All of the policies, all the different products I've talked about before, invariably trigger some form of medical requirements, whether that be a medical examination, whether that be a collation of medical data, whether that be going through an application form with an insurer that talks about medical information. That needs to be divulged to an insurance company through the advisor. If you actually understand that data and how the impact upon that will be assessed by an insurance underwriter, then you hold the USP. And that allows you to then be able to talk to as many different insurers as possible. And so we try and make it, in the first instance, convenient. We will collate the data if required. We will complete forms on behalf of the client. And with that data, we're able to make it far more convenient. We're able to reduce any time and inconvenience. And we're able to get directly to the decision makers within an insurance company to give you, the individual or the company, the best possible chance of getting competitive terms. And there are very few people that do that. I think we're one of only 4 companies in the country that I'm aware of that processes the data up front rather than putting you direct with an insurance company and thereby being held to whatever decision they make. We're not in consultation with you. Once we've compiled the data, we can go to any insurance company that is prepared to accept the risk and therefore negotiate the most competitive terms that we can get, not based upon indicative pricing, but genuinely based upon the individual's unique medical profile. And that, as I said, ensures that we're kind of true specialists in our field, and that kind of differentiates us from others who talk about these types of products that I've mentioned so far.
Fantastic. Right. Well, thank you so much. So if anyone did want to get in touch with you, I think we've had some questions, so we might send them to you afterwards, if that's all right, Toby.
Absolutely.
Which would be great, thank you. But how can people get in touch with you then?
Well, at the bottom of the slide, the next slide, I think there's my contact detail or our contact details. So there you are. We're based in London and St Albans. I work with clients, and we work with clients all over the country. I have clients down in the southwest, in the northeast, and northwest Scotland, Wales. So in this day and age, we're everywhere, and we're contactable wherever. But no, I'd be delighted to hear from anybody that would like any more information on this. It is a personal quest of mine to talk to more businesses about this, because I just don't think people are aware of the ramifications in the event of something happening to one of the people I've talked about, the key people, the shareholders, the directors, all the people. And this subject's been broached with auto-enrollment, where businesses have started to think about their people more.
Yes.
I'm now flying the flag to say, okay, that's great, really great that you set up a pension, but most people can't access their pension for a long time. This is an immediate, short-term security provision, safety net that every business should be considering as they grow, not only for the benefit of the shareholders and directors, but also the employees as well.
I think it's been really enlightening speaking to you, actually, and it's really highlighted a risk that I think a lot of people probably don't, necessarily think about. But
it's a morbid subject.
We should be.
But it's a morbid subject, and it's not something that people necessarily want to broach. However, for me, it's really sensible planning, corporate governance that every business should start to kind of employ, no matter how small they are. They should start to think of the things that can really trip them up.
Yes. Well, thank you so much. So anyone listening, if you want to get in touch with Toby directly, then you can make a note of his contact number there and his email address, toby.davidson@lumininsurance.co.uk. Nice and memorable for you. If this has prompted anybody to have any HR specific questions as well related to these topics, which, as Toby said, are actually can be quite sensitive, but things that we should certainly be thinking about for continuity, then please do get in touch. So clients, get in touch in the usual way, and anybody else, please give us a ring on 0844 324 5840. Well, I hope you've enjoyed this slightly different webinar today. We do have our usual HR-specific webinar program available for you to sign up to. So in a week or so's time, we've got grievances and top HR tips. So you can join me for that if you would like to on Thursday. We also have sexual harassment and how to handle a complaint in November, and we're rounding off the year by thinking about some interesting cases and how we can learn from the successes, but also some of the failures of some of our peers. So join me for that if you're interested. So that just leaves me then to say a final thank you to Toby for bringing us something different today and sharing your very valuable insights, and to thank those of you listening as well for joining us. I hope you've enjoyed it, and I hope you'll join us for another webinar soon. All right, lovely. Thank you, everybody. Take care. Bye-bye.